Now speaking, Pan Quintiliano, Vice President, Investor Relations. Good morning, and thanks for joining us. Today we are discussing our first quarter 2023 financial results. We will be comparing our performance to 2022, and occasionally also to 2019 to best benchmark our performance. Our non-GAAP financial measures can be found on the Investors section of our website. Jeff Gennett, our Chairman and CEO, Tony Spring, President, Macy's Incorporated, and CEO-elect, and Adrian Mitchell, our COO and CFO are with us on the call today. We had a net sales decline of 10% in the first quarter, compared to the same period in 2022, but we did see a sequential improvement from the fourth quarter of 2022. This reflects the gradual recovery of our operations as more stores reopened and store traffic increased. We have also seen strong digital sales growth throughout the quarter, driven by improvements in product offerings, marketing and customer experience. Our gross margin rate declined slightly year-over-year due to increased promotional activity and higher shipping costs, but expanded sequentially from the fourth quarter of last year. We remain focused on controlling expenses and managing inventory, which has resulted in an improvement in operating income year-over-year. Overall, we are pleased with our progress in the first quarter, and we remain confident in our ability to drive long-term growth and profitability. Now speaking, Jeff Gennett, Chairman and Chief Executive Officer. Macy's Incorporated reported adjusted diluted EPS of 56 cents in the first quarter of 2021, and net sales and comparable sales were down from the previous year. The company attributed the decline to macro headwinds, such as reduced consumer spending due to layoffs in the banking crisis, as well as an overemphasis on spring and early summer fashion and a lack of weather-appropriate apparel and footwear. Demand trends worsened in late March and further decelerated in April. At Macy's, net sales declined 7.7% and comparable sales declined 7.9%. Bloomingdale's net sales declined 2.3%, and comparable sales were down 4.3%. Bluemercury net sales rose 4.4%, and comparable sales increased 4.3%. Quarter-to-date demand trends have improved from April, likely benefiting from pent-up demand. Macy's has taken decisive actions in the second quarter and back half of the year to ensure it is well-positioned to compete, including accelerating the timing and depth of promotional events, markdowns, and clearance, adjusting the timing, composition, amount, and value proposition of receipts, and reducing its emphasis on down-trending categories. The company is also introducing Nike apparel, plus-size women's, big and tall men's, kids' bags, and gear to Macy's stores in October, leveraging its strong vendor relationships in beauty and gifting. In addition, Macy's is increasing its cost savings by an additional $200 million for this year and $350 million for 2024, and reducing CapEx spend by roughly $50 million. Macy's remains focused on achieving low single-digit sales growth and a sustainable low double-digit adjusted EBITDA margin beginning in 2024, and will continue to take action to ensure it is well-positioned to achieve those goals. Now speaking, Tony Spring, President, Macy's Incorporated, and incoming Chief Executive Officer. In the statement, incoming Macy's CEO Jeff Gennett provided a brief overview of his background and approach to leadership. He highlighted the progress Macy's Incorporated has made in modernizing its business and noted that across nameplates, we have room to improve. Gennett discussed the company's 5 growth vectors for 2024 and beyond: Macy's private brands, small format stores, Macy's Marketplace, luxury, and personalized offers and communications. Gennett also mentioned that recent results and revised outlook have not changed his view of Macy's Incorporated, but the company was out of balance in the first quarter by overemphasizing spring seasonal merchandise rather than cold weather and seasonless merchandise. He stated that the related markdowns are being contained to the second quarter, and the timing, amount, and composition of fall and holiday buys have been adjusted. The new CEO believes that success is tied to the right combination of compelling private brands, popular national brands, and the curation of unique brands appropriate for their target customers at a compelling value equation. He also discussed the small format stores and how they have achieved positive comparable owned plus licensed sales growth, with customer experience scores remaining high. For Macy's Marketplace, Gennett said they have seen increased basket size and welcomed 450 new brands in the first quarter, ending with approximately 950 brands. Lastly, Gennett expressed his excitement at working closely with CFO Adrian Mitchell and returning Macy's Incorporated to profitable growth, with the company's financial flexibility allowing them to invest in long-term opportunities and return capital to shareholders. Now speaking, Adrian Mitchell, Chief Financial Officer and Chief Operating Officer. Macy's COO and CFO discussed their alignment on what is needed to propel the company into the future. They have identified an incremental $200 million of cost savings for this year and up to $350 million in 2024, primarily impacting gross margin and SG&A. For the full year, they expect net sales of $22.8–23.2 billion, comparable sales on a 52-week owned plus licensed basis to be down about 7.5% to 6% year-over-year, other revenue to be about 3.6%, and gross margin rate of 38% to 38.5%. For the second quarter, they expect net sales of $5.1 billion, gross margin rate to be down no more than 100 basis points to last year, adjusted diluted EPS to be $0.10–$0.15, and end-of-quarter inventories to be down low to mid-single digits. Despite recent headwinds, Macy's remains committed to achieving low single-digit sales growth and a sustainable low double-digit adjusted EBITDA margin beginning in 2024, even with the assumption that macro pressures persist. Now speaking, Jeff Gennette, Chairman and Chief Executive Officer. Macy's is a modern department store with a long history that has enabled it to survive through tough times and prepare for the future. The company's financial health, operation efficiencies, and data-driven process and tools are its competitive advantages. Despite current uncertain conditions, Macy's is firmly committed to better serving customers and improving its business, while protecting and preserving the second half of 2023 and its growth opportunities, including achieving sales and EBITDA goals. J.P. Morgan Chase & Company analyst Matt Boss inquired, "Tony, where do you see the largest opportunity for accelerating growth?" Jeff, could you detail the top-line trend in terms of category or income cohorts? Adrian, what is your confidence in clearing any excess inventory this quarter? Jeff Gennette replied, "Matt, our top-line performance in the first half of Q1 was in line with expectations. However, we saw a rapid deceleration in late March and April due to lower demand for seasonal categories than we anticipated. This caused inventory levels to rise significantly. We have adjusted accordingly by scientifically evaluating 1-year CAGR, 2-year CAGR, and even 2019 trends to guide our outlook for the rest of the year. Our customers are now buying much closer to need, which has enabled us to be more responsive to market conditions." Tony Spring replied, "I'm confident that Macy's can capitalize on our strengths and create a more engaged customer experience. We have a great team, a valuable portfolio, and a tremendous opportunity to continue our success story. Our focus is on leveraging the scale of our business, investing in technology, and creating an inspiring shopping experience for our customers." Adrian Mitchell replied, "Good morning, Matt. Our track record in inventory management is strong, and we're getting better every quarter. At the end of last year we were down 3% in inventory and 7% in the first quarter. We forecast a low to mid-single-digit decline for Q2. We've implemented tools and taken action to ensure our content has the right mix of volume and freshness. We anticipated early transition from holiday to spring, but weather was cooler than expected, resulting in soft numbers in warm weather and spring seasonal items. We remain confident in our ability to work through the inventory and reset our balance entering fall." Cowen and Company analyst Oliver Chen inquired, "Jeff, Tony, and Adrian, could you please provide an overview of merchandise margins and promotions for the back half of the year, including any markdowns taken in Q2? How are you monitoring consumer behavior and what impact are transaction counts having on comp volatility? Lastly, what strategies are you employing to engage with younger customers?" Jeff Gennette replied, "Oliver, when it comes to merchandise margins, we anticipate them to be higher than last year. We are taking the appropriate markdowns where needed and have been increasing costs in other areas. We are seeing higher hours and margins compared to last year in some categories, while providing sharper price points in others due to consumer demand for promotional value. Our specials and flash sales will also be comparable to last year, and newness and gifting categories have been rebuilt based on fourth quarter learnings. So, overall, expect margins to remain stable with similar promotion levels." Tony Spring replied, "Tony, thanks for your question. Our team has done an excellent job at attracting a multi-generational customer base and specifically targeting the younger customer. We've achieved this by making sure our stores carry the brands they desire, having a strong digital presence, and using our brands to be a part of life moments like Sweet 16s and other milestones. This has allowed us to increase our business with younger customers, and we are looking to further grow our share of that market." Adrian Mitchell replied, "Good morning, Oliver. Regarding merch margin, we anticipate no more than a 100 basis points deterioration in the second quarter. For the year, gross margin should be higher than last year. As far as consumer trends go, May has been slightly better than April, but it's too early to tell if this will continue. We are being cautious with our outlook and are taking into account both the March/April trends and the potential for further consumer weakening. Goldman Sachs analyst Brooke Roach inquired, Jeff, could you provide insight on customer engagement trends between low and high-income cohorts at the end of the quarter? Adrian, what additional cost savings have been identified and how much will drop to the bottom line? Are there further opportunities to optimize the cost structure? Jeff Gennett replied, in summary, our customers are not exhibiting a trade-down behavior. We have seen an increase in average unit retail, AUR, with customers spending the same amount but buying fewer units. The affluent customers at Bluemercury and Bloomingdale's showed improvement in May, which is something we are watching closely. Adrian Mitchell replied, Good morning, Brooke. We started our cost savings initiatives about 6 months ago to address trends seen in the first quarter and year to date. We've identified 2 sources of savings, gross margin and SG&A. In gross margin, we negotiated lower rates on inbound freight, carrier network, and delivery expenses. For SG&A, we repositioned the organization for growth and identified non-payroll operating expenses to take out of the system. This year, we've identified an incremental $200 million of opportunity, with next year's annualized run rate at $300 to $350 million. We also reduced CapEx forecast from $1 billion to $950 million. Growth vectors are protected and we're investing appropriately to get back to growth in 2024. Telsey Advisory Group analyst Dana Telsey inquired, can you please expand on the hour improvement you're expecting to see in the back half of the year, which categories? Also, can you elaborate on the store strategy for Bloomingdale's and Macy's, particularly the small store component? Lastly, what do you see as bringing over from Bloomingdale's to Macy's? Jeff Gennett replied, Dana, regarding hour, we saw a 4.7% increase in the first quarter and anticipate a higher hour in the back half due to category mix. We are price matching our competitors and taking measures to ensure we provide the best value for our customers. Year over year, we expect an improvement in hour with heightened markdowns planned for both POS and clearance inventory. Our inventory reserves across categories are strong, and our merchants have the content needed to purchase as demand signals arise. Ultimately, our receipts reflect where our customers are voting. Tony Spring replied, Dana, great to connect with you again. Our goal is to create a stronger portfolio by leveraging each brand's strengths. For Bloomingdale's, that means curation and variety in their expanded assortments. They have a strong customer base representing a large portion of their business. To further engage customers, we need compelling programs to motivate them to shop in store and online more frequently. We look forward to what we can do in the future. Adrian Mitchell replied, Dana, our store strategy is focused on growth and the small format stores are part of that. We're confident in the box size and location selection, as well as the power centers we have conversations with. What's most exciting is that comps in these smaller stores are not cannibalizing those of larger stores and are providing positive growth. We believe we've found something special here and will share more information as it develops. Citi analyst Paul Juez inquired, can you provide an update on how your e-commerce business fared in comparison to stores during the quarter and how you plan to manage inventory in the second half of the year? Jeff Gennett replied, Paul, our .com and stores performance in the first quarter was as expected. We had anticipated a 25% penetration of online sales pre-pandemic and that settled at 33% after a pandemic high of 40%. Both channels saw flat traffic and slightly up stores with conversion down, at similar rates. Our marketplace model has been successful in attracting Gen Z customers to categories previously not feasible for us to carry. We have also implemented an upfront costing model instead of markdown allowance, so we are not overbuying or underpricing needed items. Overall, inventory control was good, outside of spring seasonal sell-throughs. Adrian Mitchell replied, Good morning, Paul. In terms of inventory, we've adjusted our sales volume expectations for the back half of the year to align with current forecasts. We're particularly focusing on mix and content, leaning into beauty and gifting, 30% of Q1 business, 40% in Q4, which has been growing steadily. We have more newness this year than last, and Disney and Nike will be prominent in fourth quarter. Morgan Stanley analyst Alex Stratton inquired, what is the current status of private label penetration and have your views changed? Additionally, have you adjusted your plans to invest in people and technology due to the demand slowdown? Adrian Mitchell replied, I apologize for the confusion. To clarify, could you please restate your question related to SG&A and cost savings? Morgan Stanley analyst Alex Stratton inquired, do you still plan to invest in people and technology, or has that been reduced due to decreased demand? Jeff Gennett replied, Alex, we remain committed to our private brands and expect their penetration to grow over time. We've improved existing brands such as INC and Clubroom, and have 24 more planned for the next 2.5 years. The first will launch in summer and will offer accessories, women's and seasonless basics. Private brands provide margin opportunities, brand identity, original design, strategic sourcing, size and fit, and compelling value, all reasons why we're bullish on them. Adrian Mitchell replied, Alex, the key takeaway is that we are taking aggressive actions to protect our growth investments and ensure we remain on a positive trajectory in the long term. We have reduced our capital spend and accelerated cost savings initiatives to $350 million next year, which will help us reach profitable growth in future years. Gordon Haskett Research Advisors analyst Chuck Grom inquired, Jeff, could you provide more detail on what it means to flow product closer to need and how far along you are with suppliers in this endeavor? Jeff Gennett replied, Chuck, our receipt reserve is always available to respond to changes in demand. We've shifted to a model that involves upfront cost management versus an MDA model. This allows us to maintain liquidity and quickly respond when customers signal something new. We made sure to retain some of the liquidity by doing receipt cuts when looking at total sales for the year. There were also conversations with brands to ensure we put the right receipts against categories that are trending. This is a balanced conversation for us, as every merchant knows that these receipts are assets to serve our customers. We order each week based on trends and there's ample inventory in the market to meet customer needs. Gordon Haskett Research Advisors analyst Chuck Grom inquired, could you provide an update on the performance of apparel and other areas across the board? In particular, what have you seen with textiles, top of the table, and housewares that could indicate trends in the next few quarters? Jeff Gennett replied, we are seeing a drop in our seasonal apparel categories, such as men's, women's and kids' spring and early summer content. We don't yet know if this is due to the environment or the product itself. To mitigate this risk, we are taking pricing measures to ensure that we have enough units for the third quarter. We are also seeing pockets of strength in center core and beauty categories, particularly fragrances, color and treatment. Additionally, home categories such as textiles and housewares have seen turnaround, with Uggs being an example. Lastly, Bloomingdale's home business has been quite robust and we are starting to see similar signs on the Macy's side. With beauty and gifting trending positively in the first quarter and a higher penetration of those categories in the fourth quarter, we feel our guidance is appropriate and conservative. UBS analyst Jay Soul inquired, can you tell us about the new Nike partnership and what percentage of Macy's sales it represented in the past? Do you expect this to be a long-term partnership or is it just for a few quarters? Jeff Gennett replied, Jay, our pause with Nike is over and we're now committing to a long-term partnership. We're excited to offer our customers a multi-brand or multi-category experience that's enhanced and elevated. Customers have been asking for Nike for the last year and a half, so this is great news. It will be a catalyst for us without cannibalizing other apparel assortments. Nike products will be available in October, including plus-size women's, big and tall men's, kids, bags and gear. It will be available online and in key locations, with more stores added in 2024. Our Finish Line business has also been doing well. Jeff Gennett replied, thank you all for your interest in Macy's and we look forward to discussing our second quarter results with you in August. Have a great summer.